Hello and welcome to our special show, IPO KYC. We're going to get chatting with the management of Bajaj Housing Finance, one of the most anticipated IPOs. The first one from the Bajaj Group in over 3 decades. It opens on the 9th of September with a valuation of more than 58,000 crore rupees. Its AUM is nearly 1 lakh crore and the company has grown at 30% over the last 3 years with best-in-class asset quality. Joining me to talk about the way forward, we've got Sanjeev Bajaj, Chairman, Non-Executive Director, and Mr. Atul Jain, Managing Director of Bajaj Housing Finance. Gentlemen, thank you very much for joining in. And congratulations. You all started operations, I think, just 7 years back. And in a span of 7 years of starting operations, you've become the largest non-deposit taking housing finance company in terms of AUM. So congratulations. Sanjeev, my question is that if it wasn't for the RBI diktat that all upper layer housing finance companies list within September of 2025, would you have gone public right now?
Yeah, that's a very relevant question. Clearly, the RBI requirement, given our size and being in the upper layer, was to list before September 2025. But what's equally important is that while Bajaj Housing Finance is only a 7-year-old company, as you mentioned, assets as of 31st March 24 at 91,000 crore, the fastest growing housing finance company, the largest non-deposit taking housing finance company. So it becomes important to diversify our sources of borrowing as well. Our capital has all come from the parent, that is Bajaj Finance, the last 7 years. So it's a combination of size and the RBI requirement, both I would say.
So talking about size, now your balance sheet is nearly 1 lakh crore rupees, I think 97,000 as of the June quarter. Do you think the current scale and size is a hindrance for the company to continue growing at 30% that you've seen over the last couple of years?
So let me start by saying that the opportunity for housing in this country, not only because of the way the country has been growing the last decade, but also the additional focus that the government has brought in so that there is housing for all. There is a long way to go. And while we don't target any particular growth number, we've been able to see very strong growth in the last 7 years. And this is on the back of both the opportunity that exists, the capabilities that the management has built, which Atul will talk about a little bit more now, as well as the high quality performance parameters that we've been able to report quarter on quarter. But I'm sure Atul will detail more.
So do you think 30% is sustainable?
So Reema, like Sanjeev called out, we do not target a particular number. Of course, the market size is very large. If you look at a housing market itself, let us say home loan market, which is the largest part of a mortgage market, the market by plus some estimates plus minus was 30 lakh crore plus as of AUM in the country. Loan against property 10 lakh crore plus. So the kind of a market size which is there, compared to that, our size, relative size of a 91,000, 97,000 crore as of a 30 June still remains small. So we have an opportunity to grow, but we are not guided by a particular number, subject to opportunity, market opportunity, and our ability to take space to the extent what we can take. Happy to get the outcome. More important and relevant part is, the market being very large is one part. This is also growing at various estimates on the industry at a 13 to 14% kind of a CAGR, which is a very high pace of a growth, and the way forward for the industry as well, given housing focus of the government in the country, given low mortgage to GDP ratio of India compared to even other economies, comparable economies, leave aside the developing economies. The highway to growth is there, not guided by a particular number.
So he's not given you a goal, say double in the next 3 years?
No, so it is not a goal on an individual to individual. We are a board-run company.
Oh.
Board decides a strategy at a point of a time. Sanjeev, of course, has a point of view as a board member. We have a deliverable to the board. As a head of a management team, I have a more deliverable as to the board and to the stakeholders at large. But the numbers are decided in context of the market position, and we don't get guided by any particular number.
Fair enough. So talking about the market position right now, has the competitive intensity come down because HDFC Limited, the giant in the space, has merged with HDFC Bank?
At this point of time, the competitive intensity is still high, and it's not only despite HDFC having merged, but if you look at the overall lending opportunity in the country, the one segment where banks would be traditional lenders in the private capex space for corporates has been slow, though we've started seeing some green shoots there the last few quarters. And in the absence of that, banks have participated in lending for homes because that is the largest retail asset class and one of the safest retail asset classes as well. So yes, so the competitive intensity continues to be there. But on the other hand, you know, what's life if there's not competition? That's what creates some fun.
Absolutely. So Atul, how will the product, you know, currently about 57-58% of your revenues come in from the home loan market. The developer finance is about 11%, but it's doubled over the last 2 or 3 years. So how will the product mix change over the next 3 years, according to you?
So Reema, the product mix is a function of two things for us. One is the regulatory requirements. There are regulations around, because we are a housing finance company, 60% of our assets has to be residential and 50% has to be individual home loan. So product mix is guided somewhat by that. And then since we are a mortgage full suite company, that means we say that we operate in each segment of the mortgage market, and within each segment we operate in each sub-segment. This is opportunity at a point of a time. We expand. Product mix, what is looking like at a 31st March is a reflection of that. One is a regulatory requirement. So meeting the regulatory requirement at a point of a time, plus minus, whichever is the portion which has a more advantage for the company.
So which is the fastest growing product for you?
All products are reasonably growing. All products are reasonably growing. Last 2 years, of course, you called out developer construction finance has moved faster. Lease rental discounting has moved faster. That's basis an opportunity. Lease rental discounting, the country had listing of REITs in last 2-3 years, which opened up space for large players to come in. Construction finance, the industry had been doing very well. There is a space for more housing needs, and then accordingly the more need for funding of the projects, and also it acts as a funnel for our home loan business. So needs, we are market driven, we are operating in all segments within the regulatory constraint, regulatory construct, not the constraint, the construct. We'll grow the segments which is there, but in a plus minus method from where we are today.
Okay. And what about the average ticket size? Because your average ticket size is about 46 lakh, and that's much higher than the peers. And you've opted to operate in that prime segment, which is giving home loans to 50 lakh plus. So is there going to be change in that strategy? And what about affordable housing? Because you've set up a strategic business unit to cater to that.
So Reema, we are not, we don't exclude, like I said, that we are operative in all segments and all sub-segments of the market. But at a point of a time, the focus can be on a particular segment. So the focus in the past had been largely on the prime with the dominant portion of the salaried book, which is reflective of the book composition or the ticket size of the book. But we are present in whether affordable or non-prime, because there are no standard definitions. That's why I'm choosing to call non-prime whether affordable or a mass affluent. And this is the experience, this is again the risk metrics, what we see, this is the returns, risk-adjusted returns, what we see. The mix will evolve because
so how much
from
is
this
affordable today? The one which is eligible for PMAY?
Eligible for PMY, the new PMY scheme, we have seen the announcement in the newspaper, the details are yet to come out. We'll of course intend to participate with what all we can do to assist in the government, a very important initiative, which is also very helpful to our industry. We'll make our strategy to penetrate much more once the scheme contours are out.
Okay. But as a percentage of your AUM, what is affordable housing? Sub 25 lakhs?
I won't have the exact specific number right now available on that.
So Sanjeev, talking about this current IPO, it's an offer for sale of 3,000 crore rupees plus a primary capital raise of 3,560 crore. So this primary capital, fresh issue, is going to be growth capital. You're one of the fastest growing housing finance companies. So this money that you've raised is going to suffice the company for how long? When do you think next the company will need to come to the market?
Well, with the internal projections on where we are likely to be in the next couple of years, and which today I'm not at liberty to share with you, but once
so I'm glad you're going public, right?
Once we are a listed company, as I said, that thing could change, that situation will change. But we think for the next couple of years, this should suffice. And as you know, we have the requirement to dilute 25% over the next 3 years. And depending on how growth is going in the coming years, we'll take that call between primary and OFS.
Okay. So when you say couple of years, we're talking about 0 to 3, 3 to 5, more than 5?
Right now, this capital should be for the next 2 to 3 years.
2 to 3 years.
But again, as I said, it will all depend on industry growth, our growth, so I'm not trying to project anything right now.
You always think long term, right? So today, promoter stake comes down to 88%, approximately. Eventually, you will bring it down to 75%. What about thereafter? Will Bajaj Housing Finance continue to remain a subsidiary?
Our plan right now, keeping in mind that we have a very long journey before the risk of not being a subsidiary for the foreseeable future, very much so.
You use the word offer for sale also, right? When you eventually need to raise growth capital, you spoke about OFS, so that's why I asked.
Yes,
beyond 75%, will
correct.
promoters look to sell stakes?
So the OFS is also, as we know, an additional tool available to reach the 25% in 3 years' time. So that's the reason that I talked about it, Reema. Each of these businesses, whether Bajaj Housing Finance or its parent Bajaj Finance, has grown over the years, raising capital when required. And at some point of time, your growth and the earnings from that ends up sufficing the capital requirements. So I think they still have a while to go. They're just 7 years old, but we'll see with time.
And what will Bajaj Finance do with the 3,000 crore that they're raising?
Well, Bajaj Finance is also very much a growing company, so it will continue to use that capital for future growth.
Atul, how do you think the brand Bajaj has helped? I know it's AAA rated, one of the few housing finance companies with a AAA rating, but if you could enumerate the ways Bajaj Brand has helped, and also in terms of cross-selling, because you have an extensive list of customers, you've got their credit history.
So I think, Reema, the Bajaj Brand had been the most essential ingredient in whatever we have built till today. Now, from 2 points, both on the assets and the liability side, I'll take a minute to elaborate on that. On the asset side, specifically the market segment we operate or the customer segmentation we operate on the prime side, or even when we go for a construction finance or lease rental discounting, the brand is a paramount important for the customer to choose the financing partner. There, Bajaj Brand as a heritage brand, as an established trustworthy brand, a symbol of a trust, helps us. Then Bajaj Finance as a parent company, their heft in the financial services, their known agility helps us establishing in the mind of the customer, or helps the decision of the customer of choosing Bajaj Housing Finance to be their partner in financing. That's on the asset side. On the liability side, again, the brand helps us to give comfort to the lenders to be able to see out of a 91,000 crore balance sheet, what we had on 31st March, the capital was 12,000 odd crore number. Balance money has to come from the market in terms of a lenders. From the lender, the trust of the brand, and the rating also is reflective of a trust, of course, of a performance of the company, capital or the profitability of the company. But the brand helps in the both ways. On the asset side, putting customer mind at ease with the brand they are dealing with. On the liability side, helping us to raise money at a competitive price, which helps us to be competitive in the market to get more customers. Because money, effective reduced cost of borrowing or the optimized cost of borrowing is the most essential ingredient in our kind of a business, which is typically a low margin business, to attract customers.
Indeed, you all did start off by saying one of the objectives of this IPO is to diversify the sources of borrowing. So how much do you think your cost of borrowing could come down by, now that you'll be a public company?
Listing does not bring down the cost of borrowing, because we are already a AAA rated, and I don't think there is a high rating in the country beyond AAA. What Sanjeev was referring, the diversifying cost of the methods of capital. So our cost of our borrowings are already diversified. We use a mix of banks, to National Housing Banks Refinance, which is who's our supervisor, to the money market, to the CP. So we use diversified borrowing mix. Cost of funds is not going to be impacted by the listing requirement, because there is no differential as far as it is concerned. But we diversify our source of capital as we continue to grow forward.
Are you seeing any signs of stress in the market right now? Your asset quality is best in class, pristine, if I may use that word. But are there any signs of stress?
No, not in the housing finance space. In the segments that we are in, a combination of very thoughtful acquisition strategy, leveraging data, leveraging analytics has helped us ensure that what the business that we have built in the last 7 years, and even as we see it right now, is of high quality. So these are also choices, Reema, to be made. And you asked a question on affordable housing finance as well. Now, as we build out each of these business lines, we are also thoughtful to not just do everything together, because then you end up taking disproportionate risk. We are balancing it out by building the teams, building the tech capabilities, the distribution ability, trying to understand what customer segments we need to participate in, and that way gradually build out each of these lines. And as we gain more experience, and I'm sure we'll make some mistakes, we learn from that and apply that back. And that's been our learning from Bajaj Finance over the last 17 years and our learning from housing finance the last 7 years.
Okay. What is your view on your net interest margins? In Q1, it dropped on a year-on-year basis. What's the outlook over the near term?
We can't talk about the future outlook on the names, but in a mortgage business, which is a variable asset, 100% variable, so the construct of our business is that the asset side is largely variable. Most of the assets are variable or the floating rate of interest, while the liabilities are part variable, part fixed. So in the times of at a point of a time, there can be a bit of a mismatch in the spread being higher. So in fact, I'll call out that FY23 was a higher spread, FY24 was a normalization of a spreads from compared to FY22. You compared FY24 to 22, it was a normalization of a spread. FY23, because the liabilities took some time to catch up on the to have the cost of fund. So as of June, it is balanced between whatever the flow through of a liabilities had to come. At a cycle level in the mortgage, because it's a longer tenured business and a differently natured business of a variable rate on both sides, assets and the liability side, I think over a cycle, their margins remain stable. In a quarter or in a year, there can be pluses and minuses on
so
the
around
margins.
4%? NIMS, is there any reason to believe it should not be?
Cannot
so
be
margins
specific.
should remain stable, according to you?
Margins by and large remain stable through the cycle.
Through the cycle.
Through the cycle, not at a point of a time. At a point of a time, it can vary.
Okay. So your valuations are about 3 times price to book, which is at a premium to peers. I know this is advised by the bankers and you all go with it, but do you think you've left money on the table?
Well, we'll find out.
Your own view?
Our own view is to build a high-quality, balanced business and to balance out the requirement both of new and existing shareholders. Eventually, there are a large number of retail shareholders of Bajaj Finance which have promoted this company, and both should benefit, and we think that's what we've done.
So both should benefit. So that means you've left money on the table.
We'll find out.
We'll find out. Okay. Just one final, a few more questions on the business. Now, about 85% of your business is concentrated in a few states. I think Maharashtra, Karnataka, Telangana, New Delhi, etc. Would you look to diversify your geographical presence? Is that something which is on the cards?
So, Reema, when we look at the construct of the market, and specifically when we are calling what you called out that we are more focused, we had been more focused on the prime mortgage space, and coupled with recent discounting in the construction finance, that business is naturally more concentrated towards top 6 metros in the megapolis in the country. So that's what the market side, the way the market is constructed in the space, what we operate in is what is reflected in our book when you see the concentration. Of course, over a period of time, we had always grown geographically in a gradual manner, because being a value business, not a volume business, the geographical expansion is always gradual. We had been gradually expanding. We'll continue to expand gradually to cover from a market coverage point of view. But value-wise, it is going to be concentrated in the way the market is concentrated.
Okay. This is a very competitive space, Sanjeev. And you said that, there hasn't been any let-up in terms of the competitive intensity. What, according to you, is the reason why Bajaj Housing Finance has grown so much faster? I was seeing the comparison of your peers. So LIC Housing Finance, the one which is bigger than you, has grown at 8.5%. PNB has actually declined in terms of, the growth rates. Canfin Homes is about 15%. What, according to you, is the reason?
There are a combination of factors, Reema. One is a home loan in India is a loan against a home that you're staying in. For most people, it's not an investment property. And hence, to have a housing finance company or a bank that you can trust through the period of your loan becomes important. And we've been fortunate to have the Bajaj brand name. So it helped us start at a good point. Second, the market itself. While the market is competitive, the market is very large. And the challenge as we've built our business is not so much on the asset side. The challenge is, can you build a large liability book? Can you create confidence amongst your borrowers to be able to build this kind of size? And I believe we've managed to do that so far. And as Atul mentioned, the diversified nature, not only on our asset side, but also on the liability side, not only increase the sources available to us, but also reduce risk through that diversification. And then it's a combination of our insights into customers, it's a combination of leveraging data to understand which micro markets, what kind of product is suitable, what is the right ticket size, what is the right distribution strategy, and then our tech capabilities for quick turnaround times. So the customer will still take a certain amount of time to decide on the home, but everything else, if we can reduce friction in their lives in getting a housing loan from us, we believe that gives us a little bit more advantage than with everybody else. Because the pricing is very much, if you're in the prime segment, if you're in the affordable segment, the pricing is very much similar, because again, this is a long-term expensive loan. And you risk that if you get too much out of the band, you risk adverse selection as well. So this is not so much a game that works on differential pricing. It's on everything else.
And one final question, since you spoke about the softer aspects work in a customer choosing who they will bank with, how long does it take now to get a home loan finance? Because everything's getting quicker. We're in the quick commerce business world. So how long does it take now compared to what it did, say, 3 years or 5 years back?
So the process from us can be through the digital side of what we do fairly instantaneous. But customers still on average takes 30 to 45 days to decide on the apartment. This is a lifelong decision. And naturally we don't influence and try to influence that. But before and after, the rest of the process happens very seamlessly. And other than a few steps which require interaction in the physical world, everything else that can be digitalized is digitalized.
Amazing. Thank you, gentlemen. This has been a great conversation, an eye-opener. Wish you all the very best. Thank you.
Thank you.